Welcome back. I'm sure you know by now, but Amazon has announced that they're going to be doing a 20-for-1 stock split. This created a lot of hype around the stock. A lot of people I usually don't hear talking about the stock market have been asking things like, oh, should I buy Amazon? Hey, you should look at Amazon, that type of thing. So what I wanted to do with this video was do a deep dive into the financials and see if we can come up with what we think is a fair value for Amazon. It's really difficult, and you'll see why as we get through the financials, because they don't run like every other company. You can't really judge them by traditional metrics. And that's kind of why I avoided it for so long, because it's so difficult, but I think I got to a good spot on it, so I'm excited to share that. All right, real quick, I just want to show you this, the 20-for-1 stock split and a $10 billion buyback. I want to get all happy about the buyback. I mean, look at this, $10 billion is like, wait, let's see, $10 billion compared to their market cap. So I'm doing 10 billion divided by 1540 billion, which is their market cap, 1.5 trillion. That's like 0.6% of their entire market cap. So this is just like, you know, less than pennies, 0.6%, okay? All right. As for the stock split, I know what everybody who's any type of value investor is thinking. Stock splits do nothing to the value of the stock, and that's true, right? It doesn't really change the value of the company. It just takes the pieces of the pie and cuts them up into smaller pieces to where everybody still has the same percentage, but now you got a bunch of different pieces. But what it does do is, one, it creates hype for a stock, and we're going to see that. I'm going to show you some history of other stock splits. But also it creates a lot of volatility because people who couldn't buy it before, not so much the stock, but also the options, because options contracts are for 100 shares of a stock. So people who couldn't afford 100 shares of Amazon before, which, let's see, what is 100 shares with $300,000? Yeah. So if you're like me, this is going to be way out of your price range for an option, right? You're not going to be swinging $300,000 around like that, but you know, you might be able to do $15,000, which is what the options contract's going to turn into roughly, assuming the share price stays the same after the split. Okay. All right. So let's see. Look at this. It's the first split since 1999. All right. Let's see what else. This is what I wanted to show you. Amazon announced its first stock split since the dot-com boom. All right. Good. That's a good sign, right? What happened after the dot-com boom? Okay, no, I just thought that was funny. Okay, let's look at some other stock splits, and the big ones are Tesla and Apple, because those are the two most recent, you know, big trillion-dollar market cap companies to do stock splits. So it's kind of interesting to see what happened with them. Like I've said before, I'm not a technical trader. I don't try to predict short-term price movement, but you know, some people out there might find this interesting. So this is a chart of Apple in purple and Tesla in gold. Great colors, by the way. This starts at their announce date right here, and then this is their split date, the S here, and so it shows you what happened to the stock price after that, okay, or after the announcement date. And you can see both of them really ramped up before the split, fell a little bit after the split, but still wound up, you know, Tesla wound up 40% over, and Apple wound up 18% over. Is that same thing going to happen to Amazon? You know, who knows, right? But I just thought that was interesting. This is a good article. I'll link this article in the description if you want to read it. Let's see. They say, this is what they say, the perfect world, the best time to buy is before or on the announcement date. However, if we miss that trade, it pays to wait patiently until after the split to add to your holdings. Interesting. All right, let's look at their stock price history and see what's going on there. Okay, so what I have here is a 5-year chart for Amazon, and you can see over 5 years they've been up, let's see, 200%, which is pretty good, but compared to some of the other big players, I mean, that they've been stagnant these last couple of years, right? This is July 2020. They haven't really made any ground since then, right? It's been pretty stagnant, you know, minus 4% actually from August 2020 till April 2022. And I don't know what the reasoning behind that is, but what I've thought for a long time, really before this video, is that it had something to do with these ridiculously high ratios over here that made me think it was extremely overvalued, right? Their PE was close to 50, is close to 50, 47 right now. Price to book in double digits at 11, and the price to sales, even though the metric I don't really like that much, is over 3. So all that I think could have contributed, or you know, it makes it look overvalued at first glance, but what we're going to do, you're going to see that there's more to this story. All right, so let's go through the financials. Really, we're going to just focus on the income statement, and I'll kind of talk about why, but let's get started. Okay, so like I said, we're going to go over the income statement only. The main reason is time. The second reason is that for a company like this, big trillion-dollar company that's just making money hand over fist, growing like crazy, you don't really need to look at the balance sheet. You probably should if you're doing your own due diligence, but you know Amazon's going to be around a long time, right? But the balance sheet is mainly, you want to look at companies that could be in a cyclical business or companies that might hit a rough patch. You want to make sure they're not in a ton of debt, that they don't have, that they're not upside down, you know, that they can handle bumps in the road, okay? And then the cash flow statement, that's a lot like the income statement. I'd pay much closer attention to the cash flow statement if I'm dealing with, you know, like a big manufacturing company or something that could be spending a lot of CapEx or could be manipulating inventory or something that wouldn't show up on the income statement but would show up on cash flow, that type of thing, okay? But like I said before, the primary reason's time. I want to keep this video short because I think it's valuable and I don't want to drag on too long, okay? So total revenue, this is every quarter going back to March 2012. So the first quarter 2012 all the way to the last quarter of 2021. So we got about 10 years of data here. The first thing I want to point out here is this revenue growth. I mean, this is insane. This is like a great exponential. Look at this. So they went from $20 billion a quarter in revenue only in 2012 to now being $140 billion a quarter in revenue. So first up, I'm going to mark what their current revenue is. So the current revenue is 140. It looks like, you know, that it spikes up every once in a while. So I'm going to come down a little bit. I'm going to say 130. So I do 130 times 4 because this is per quarter. So I got to change it to year. I get $520 billion a year of revenue is our projected revenue. Okay. Next, I need to get a growth rate. And I just said they went from 20 to 140 in, let's see, from the end of 12/31/2012 to 12/31/2021. So that's 9 years. They went from 20 to 140, okay? So if I do 140 divided by 20, they went up 7 times in 9 years. I raise that to the 1/9, and I get 24% growth rate, okay? One other thing that you want to look at here is make sure that the recent short-term growth rate is at least as high as the long-term one, because, I mean, you can see visually it's pretty consistent throughout. But if you're just looking at numbers and you don't have the visual representation, you can do this too, where you say, let's pick the end of 2018. So they went from 72 in the end of 2018 to 140. So 140 divided by 72 is 2, and they did that in 3 years because 2018 to 2021 is 3 years. So raised to the 1/3 is that same 24-25%. It's actually higher. So that's a good sign. Consistent growth pattern, all right? Like I said, you can pick that out from the graph here, but if you don't have the graph, it's good to do that as well. So we got the revenue, we got their growth. Next, we're going to look at gross margin. Let's see, gross margin. All right, so I'm going to put this in percentage, and you can see consistently they're making, what is this, like 11%, 12% gross margin. So that's taking their revenue and then they subtract out their cost of revenue, which is like the raw materials, right? If they're selling you something, they're subtracting out whatever their base costs are. So that's your gross margin. It's mainly just raw materials, like I said. That's pretty low, but we've seen that with high growth companies before. And if a company's got 24% revenue growth year over year for the last 10 years, I'm not going to be as critical about how they're doing that, right? Because it's obviously working. Okay, so let's see, operating margin. And one other thing about gross margin, I say that, you know, you always want to look at operating margin to judge, not operating margin, you always want to look at gross margin or operating margin to judge a company's competitive advantage. But in this case, I mean, does anybody really question Amazon's competitive advantage? I mean, I think that they are probably, it's between them and Costco for me, are the two places I spend the most money voluntarily. That's not like a bill or something like gas where I don't care who I buy it from, just whatever gas station's closest. I mean, we choose to spend money at Amazon and Costco. And Amazon, think about this. Amazon, and this is something I heard Monish Pabrai say talking about Amazon. I thought it was so interesting. How many times have you bought something from Amazon where you don't even check the price anywhere else? I mean, think about that. I mean, I could think of probably the last 20 things I bought from Amazon. There's no way I check the price anywhere else because it's built that image of being a low-cost quality provider that's going to be consistent and reliable. And that's their competitive advantage. You know, you're not going to decipher that from looking at these margins. That being said, though, this is extremely low. So their operating margin is hovering between 0 and like 6%, but really, I mean, it's been 2 to 4% recently. And that's really what's going to make valuing this stock extremely difficult, because one thing that Jeff Bezos and Amazon has always done is that they try to really not make any operating income because they want to put everything back into the business and just grow, put the customer first. I mean, it's a great business model. It's just extremely hard to value because all of our metrics come from what? Income. It comes from pre-tax income, earnings per share, and cash flow. Well, if you're reinvesting all of your earnings back into your business, how do you even judge that, right? It's crazy. Well, we got a way I'm going to show you at the end. Okay, so I want to just break down their cost real quick because if you remember, their gross margin was low, their operating margin's even lower. So I just want to show you kind of where a lot of this is going to. And this is how Yahoo Finance classifies its expenses. I'm sure if you read Amazon's 10K or 10Q, you'd get a much better detailed explanation, but I'm going to look at it just how Yahoo Finance classifies them. All right, so first up is general, administrative, and other. So G&A. So G&A as a percentage of your gross profit. So this is like what percentage of our gross profit are we spending on just general administrative, meaning, you know, pretty much paying people, dealing with administrative stuff and things that aren't related to marketing, sales, research and development, that type of thing. And you can see that this is not the culprit, right? They're spending a pretty low percentage here. And I like that. I don't like companies that spend a huge percentage on general and administrative because those really don't grow your business that much, right? On the other hand, things like sales, marketing, research and development, that'll grow your business. So here is sales and marketing, and look at this. Yeah, they're spending upwards of 60% of their gross profit on just marketing and selling expenses. And that's what I like the most about this. I mean, these are kind of like optional expenses, right? Especially the marketing side of it. I mean, did I spell marketing right? I don't even know. I'm a numbers guy, not a spelling guy. All right. Okay, so anyway, what I mean about marketing is like, that's advertising, right? Or, you know, other types of marketing. They don't have to do that. So really you can kind of view some of these optional expenses as income that they're choosing to spend or invest in the same fiscal year to just reinvest in their own business, right? It'd be like the equivalent of a company who's making a bunch of money, but spending it all on CapEx, right? You would see low cash flow, but you'd see higher income. Here, they have so many opportunities. They're able to spend the money right away, huh? So I just think that's super interesting. It's, you'd much rather see it here than in G&A for sure. All right, let's see what else. All right, yeah, next I want to look at interest as a percentage of their operating income. So I said I wasn't going to look at the balance sheet, but this just kind of gives me a good idea of financial health. You know, I want to make sure the company's not spending a ton of its income on interest payments, which is, like I said before, just like another tax. All right, so you can see here the scaling's all messed up because of these weird negatives, but I mean, we're hovering close to zero. Let's see, let's just take an average. Yeah, 5%. That's low. That doesn't concern me at all. All right, lastly, I want to look at net margin. Let's see, net margin. And this is a metric I actually want to record because we're going to use this in our valuation, okay? So you can see that, you know, they went a long time without making any income, right? That means 0 to 2%. Recently, they have been delivering some income, so they have been getting some margin. The margin's not 0. I got to record this. Like I said, what do I want to put? I think I'm just going to put right here 7%. That seems pretty reasonable. Because I'm going to use that later. You'll see what I'm talking about. The good news is it's kind of growing, so maybe I should put 8% if I'm trying to project what the net margin is going to be in the future. So yeah, let me put 8%. All right. Lastly, we're going to look at, what is this? Other income expense. Okay, yeah. Okay, so what's confusing here is that if you look at their operating margin is lower than their net margin, which is insane, right? So their operating margin's like 2 to 4%, but their net margin, which is after interest, after other expenses and stuff, is higher, and after taxes even, okay? So this is kind of crazy. I'm going to say it again because you're probably never going to see it again in another company. Their operating margin is, you know, 2 to 4%. Then you subtract out interest, you subtract out other income, and you subtract out taxes, and you come out with a higher number. Now, what's going on, right? Usually, if this is going on, it's something with other income, so that's going to be what we look at. Let's see, other income. Oh, I got to go back to dollars. Yeah, and you can see here, they had a big sale of something worth, what is this, $12 billion. And then they've just been generating a lot of other income recently. So you know how we saw that the margin was creeping up? I don't know if that's from the operating end of the business. They might just be selling some things and generating other income. Usually other income is from the sale of assets. This would be another thing that you'd want to look at in the 10K, right? Okay, real quick, let's just run through their pre-tax income and their earnings per share, just because I usually do this for companies, but for them, this is not how you want to value the company. If you come here and try to value them like this, you're going to get a ridiculously low number, right? So let's say, look at how I normally do this. Like, let's say I normally take the trailing 12 months for the pre-tax income, and I say that it's $38 billion. I multiply by 10, and I compare that to the market cap. I ratio that down to the market cap, so I would say that the fair value of the stock is only $750. That's ridiculous. That's low. That's not at all what I think the fair value is, but that's just one of those reasons why you need to treat each investment as an individual thing. You can't just have formulas that you stick on any random company and come out with a number. Likewise, earnings per share is going to be really low too. I mean, we saw that because of the PE. Let me put some decimals back in here. Yeah, so look at their earnings. Even if you include this super high one, their earnings sum to $65 a share, right? They're selling for 3,000. So 34 divided by 65 is a PE of 46.67. Again, at first glance, super overvalued. Okay, so how are we going to value it if our two normal metrics aren't even worth anything and we're not even looking at free cash flow? Well, the way I'm going to do this is we're going to project out revenue for the next 5 years and then apply some margin to that and discount it back at a fair value. Okay, so you'll see what I'm talking about. All right, so here's our page. It looks like a lot, but really this is just step-by-step calculation. What I could do if I wanted was just plug in a couple numbers and have it spit out an answer, but I want to show you how to get to this number on your own instead of just having some black box magic formula, right? Okay, so what we want to do is want to put current revenue, okay, which we said was 520 billion. So 520 and then 1, 2, 3, 1, 2, 3. That's right, huh? Yeah, that's 500 billion, 9 zeros. Okay. All right, next we want to look at revenue growth rate, and we said that was 24%. All right, and then what that's going to calculate for us is revenue after 5 years. So the way that you do that, I'm going to do it up here in the calculator so that you can see it, and then I'm going to go back and put it in Excel. Is you do that 520 billion times 1.24, and then you raise that to the 5 years. So the revenue is growing at a rate of 24% a year. That's the formula. So you get $1.5 trillion of revenue after 5 years. Okay, so I'm going to do that in Excel real quick too, because I want to change the assumptions around after we do the initial thing. All right, and we get, yeah, $1.5 trillion. Net margin at 5 years. So I'm going to say that same margin, that 8% margin, all right? So I put 8% there, and then income at 5 years. So what is income? Income is revenue times your net margin, right? Because to get net margin, you do income divided by revenue. So to do that, I'm going to put this revenue number here. So let's just say it's 1524 trillion. And then you multiply times 0.08 because that's 8%. And you get $122 billion. So I'm going to do that here as well. So this times that. All right, $122 billion income after 5 years. The market cap is just going to be that income times whatever PE you want to use. For a high growth company like this, I'm going to put a PE of 20. So up here in the calculator, I would just multiply by 20. So you get 2.4 E12, which is 10 to the 12, which is trillion. So 2.4 trillion. So I'm going to say that the market cap is going to be $2.4 trillion after 5 years. All right, so now we got to go from the market cap to the stock price after 5 years. And the way I'm going to do that is I'm going to divide the total market cap by the number of shares. So this number up here, 2.4 times 10 to the 12, divide that by 509 million. So 509 and 6 zeros, 1, 2, 3, 1, 2, 3. Okay. And I'm going to get a share price target of 47.90 after 5 years. So let me put that over here. So this divided by 509, 1, 2. Okay, so this is what I think the share price is going to be after 5 years, which is good, right? I'm saying even after 5 years, if you bought it now, you know, you'd have gone up from, what is it, 3,000 to 47.92. So 47.92 divided by 3,000 or 30.34, you'd go up 57, 58% in those 5 years. So that's good, but you have to discount that, right? Because it's 5 years away from now. So what discount rate are we going to use? I say I like to use 15%, so let's do 15%. I think that adds a margin of safety, and like I've said before, if you're putting this much work into investing, you should be hoping for more than a 15% return. Well, that's ambitious. Some people, I think 12 is more accurate, but I like 15 because it has margin of safety in it, kind of built in. All right, so let's do this. So the way that you do this calculation, I'm going to draw the formula out here because I think it's kind of complicated. What color? White, yeah. Okay, so you just do 47.92. Man, I'm a slow drawer. And you divide that by 1 plus that discount rate. So 1 plus your discount rate. And then you raise that to the number of years, okay? So back up here in the calculator, what I'm going to do is 47.92 divided by 1 plus 0.15, because it's 15%, raised to the 5. Yeah, and I get a current price target of $23.82. So right now, I think fair value for this stock is $2,382 a share at a 15% discount. Let me make this a calculation again because I want to change up some assumptions and show you some interesting things. Okay, so it's this divided by 1 plus this raised to the 5. All right. Now watch this. Watch what happens if we change up some of these assumptions. All right, so let's say that they're not going to be at 8% margin. Let's say that they're able to run at 11% margin in 5 years, which isn't unreasonable. If I go back to the margins trend, let me show you real quick. If I go back to margin, where's net margin? Net margin, put this back in percentage. You can see, I mean, they're trending up. So after 5 years, it's not unreasonable that they, break 10% net margin, okay? I mean, 5 years ago, they were at 2%, and now they're at between 6 and 8, all right? So let's see. So if I put 11% here, you can see my net present value turns into $32.76. So I think the stock's actually undervalued if they're going to be at 11% margin in 5 years. Likewise, let's say that you think 15% is too harsh of a discount rate, and you want to discount at 12%. Now you're saying the stock really should be worth $3,700 right now. I guess what I'm trying to say is that there really are assumptions you can make that make Amazon a buy right now. And like I've said before, that's what the difficult part of investing is, right? The formulas are easy. Everybody can learn the formulas. It's the assumptions, because 37.39 is a lot different than what was our number. It was this and this. Then $23.82. But I hope even if you don't want to buy Amazon, you can apply this to any other stock that you're invested in and see what you think fair value might be 5 years down the line, right? That's all I got. I hope you enjoyed the video. I hope you did learn something. If you did, like, subscribe, check out more videos, and I will see you next time.